Welcome to this explainer. Okay, be honest with me for a second. Are you feeling a little fatigued when it comes to the endless, exhausting advice out there about retirement savings? Or maybe you're dealing with that nagging anxiety that you're just, well, way too far behind to ever catch up. Listen, if that's you, you are absolutely not alone. Today, we're going to unpack a really straightforward, highly structured framework from our source material called the SCHD Blueprint. It's all about building your retirement through the slow, steady, and incredibly reliable power of dividend compounding. Let's jump right in. So millions of us, particularly once we cross that 40 mark, wake up with this exact sinking feeling in our stomachs. Have I started investing too late? It's a paralyzing fear, honestly. And worse, it's the exact fear that keeps people from starting at all. But here's the thing. What the data and the strategies we're looking at today actually suggest is that you really might not need a massive pile of cash up front to catch up. We're going to break down exactly how everyday people are attempting to build real financial security from scratch. And believe it or not, it all starts with a surprisingly quiet, completely unflashy number: $100. What we're unpacking today is an almost famously boring strategy centered around investing just $100 a week. That's it. This simple repeating habit aims to potentially build a seriously powerful stream of passive income for your retirement years. We aren't talking about overnight millionaire schemes here, and there's definitely no frantic day trading involved, just a steady, incredibly disciplined approach that literally anyone can understand and put into practice. Let's move to Section 1, inside the SCHD engine. Okay, let's dive into this. The entire engine driving this strategy is SCHD, the Schwab U.S. Dividend Equity ETF. If you've been hanging around financial circles recently, you already know this specific fund has quietly become one of the absolute most talked about wealth-building tools for long-term investors. And the reason why is because it totally bucks the current cultural trend. Think about it. The internet is just completely obsessed with chasing the flashiest tech stocks or riding that high-anxiety roller coaster of risky crypto hype, right? Checking your phone every 5 minutes just to see if you're a millionaire or if you're totally broke. It's exhausting. But the SCHD Blueprint, it's the ultimate tortoise in this race. We're talking about consistent dividend income, stable blue chip companies, long-term compound growth, and building a passive cash flow that is specifically designed to just steadily grow over time. And here is what actually drives that steady growth. We're talking about heavy hitters like the Coca-Cola Company, PepsiCo, Chevron, Verizon, Procter & Gamble. The source material makes a really vital point here that we can't gloss over. These are not volatile, unproven startups hoping to strike gold. These are monumental, absolute bedrock companies that have already survived massive recessions. They've outlasted crazy inflation spikes, weathered huge market crashes, and they've adapted to decades and decades of economic shifts. By putting your money here, your focus shifts entirely to building reliable income that could potentially pay you out every single month once you hit retirement. Moving right along to Section 2, the SOS investing method. Now, knowing exactly what to buy is really only half the battle, right? The real practical question is, how do you actually fund it without totally stressing out your day-to-day budget? So the crucial point is, this method takes wealth building and breaks it down into 3 incredibly simple, bite-sized steps. Start small, optimize raises, and surge with lump sums. Honestly, breaking it down exactly like this completely removes that overwhelming, suffocating feeling of needing a giant lump sum of money right out of the gate. Let's look a little closer at exactly how each of these steps works in the real world. Let's break down that first S, start small. Hear me out. You absolutely do not need thousands of dollars to begin. Even $50 to $100 weekly, if you invest it consistently, snowballs massively over time, thanks to the magic of compound growth. The source makes this crystal clear. The absolute biggest mistake everyday people make is just waiting. Every single year you delay starting means you are permanently kissing years of compounding power goodbye. Next up is the O, optimize your raises. I love this because it is such a brilliant, low-stress tactic. Whenever you get a salary increase, maybe a sweet bonus at work, some extra cash from a side hustle, or hey, even your yearly tax refund, you simply increase your investment contribution just a little bit. You don't have to overhaul your entire budget, and you definitely don't have to eat nothing but rice and beans for a decade to make this work. This is exactly how the quote-unquote quiet millionaires slowly build substantial wealth without dramatically altering the lifestyle they already enjoy. And finally, the second S in our method, surge with lump sums. It's wild how many people waste extra cash windfalls, like that annual bonus or a sudden chunk of freelance income, on random things they literally forget about a month later. Smart investors, on the other hand, they funnel those extra funds straight back into their dividend investments. Over time, those lump sums act like a massive surge of adrenaline, accelerating your overall portfolio's growth dramatically. All right, let's hit section 3, the drip snowball effect. Now that we've totally covered the SOS funding method, we need to talk about the underlying mechanics behind the scenes. The real engine making all of this work is called DRIP, which stands for Dividend Reinvestment Plan. Instead of letting your hard-earned cash dividends just sit idle in your brokerage account doing absolutely nothing for you, DRIP steps in and automatically uses that cash to buy more shares. It handles the reinvestment completely for you. And guess what those brand new shares immediately start doing? Yep, they generate even more dividends. And this brilliantly illustrates the true snowball effect in action. Dividends buy shares, those shares generate more dividends, and then the cycle just grows exponentially over decades. This beautiful compounding mechanism is exactly why long-term dividend investors can stay so incredibly patient and calm, even when the market takes a severe nosedive. They know for a fact that their machine is always running in the background, automatically accumulating more shares while everyone else is panicking. Next up, Section 4, the yield on cost. Now, what's really interesting about this is that this steady, automatic accumulation is the exact reason why investors over 45 just absolutely love dividend ETFs. As you get closer to retirement, you generally start caring a whole lot less about getting rich fast and way more about stability, creating passive income, and just lowering your stress levels. So imagine buying shares today that pay a 3% initial yield. On its own, 3% might not look life-changing, right? But because of the dividend growth and that drip strategy we just talked about, decades down the road, you could effectively be getting a 7% yield, or honestly potentially much more based on your original cost. You lock in your initial price today, but your cash flow from that exact same initial investment just keeps climbing higher and higher over the years. This completely, fundamentally shifts your focus from stressful day trading to confident, long-term holding. The longer you hold on to quality dividend investments, the more powerful that compounding becomes. It's like that old, famously true saying goes, time in the market beats timing the market. Dividend investing fundamentally rewards patience, not frantic speculation. Let's ground this with Section 5, the reality of risk. Okay, let's bring our feet firmly back down to the ground and be completely 100% transparent here. SCHD, and really any dividend strategy for that matter, is not some magical, guaranteed money machine. Dividend ETFs can and absolutely will drop during bear markets. And because SCHD explicitly doesn't hold those flashy tech companies we talked about earlier, it can noticeably underperform during massive tech stock rallies. You might also experience periods of slower dividend growth or see lower returns in some individual years. That is exactly why smart investors never rely on hype. They focus strictly on consistency, wide diversification, long-term thinking, and highly intelligent risk management. Which brings us to the ultimate lesson of this explainer. The biggest takeaway here isn't actually just the SCHD ETF itself, it's the profound understanding that small investments really, truly matter. Consistency matters, starting early matters, compounding changes absolutely everything about the math of wealth. Even investing incredibly modest amounts regularly can potentially create just unbelievable long-term results. But the hardest part, honestly, is usually just taking a breath, taking that first step, and starting. So I leave you with this one thought. Will you let another year of compounding slip by? Thank you so much for joining me for this explainer. Keep focusing on your learning, and we will catch you on the next one.